news, and welcome to the new week. It's Monday, the 3rd of August. Today we're talking about how the USD is falling and the structural shift. The USD had a positive close on Friday night after the DXY hitting 92.5. From its peak of 103 on the 19th of March, when gold and silver got smacked, the mighty US dollar has been on a steady decline, whilst gold and more recently silver have rallied. At 93.5 now, it's also down 3.6% for the year. Check out this next graph here, shown from around January, February this year, up until August the 1st and 2nd today. The reason, yet again, is all around debasement. The Fed has printed so much of this stuff, fears of debasement-related inflation are building. The numbers around that stimulus are truly staggering. In the context of that record negative GDP print last week, Q2 saw $4.85 trillion in nominal GDP. In the same quarter, approximately $5 trillion of fiscal and monetary stimulus was injected into the economy. And so for the first time in history, stimulus exceeded GDP of the biggest economy in the world. Year to date, it looks even worse. The Bank of America Merrill Lynch Chief Investment Officer Michael Hartnett spelt out late last week that 2020 has seen a total of $20 trillion of stimulus unleashed in the US, comprising $8.5 trillion in monetary stimulus from the Fed, as well as zero interest rates, and $11.4 trillion in deficit US government fiscal stimulus, and that is just to date. Hartnett also talks to the unprecedented inflows into gold ETFs, some $16.7 billion in just the last 6 weeks, but also the coinciding exit from cash after the huge rush into USD in March. Bank of AML private clients currently have 58.7% in equities, 22% in debt or bonds, 13% in cash, and just 2.3% in gold and silver ETFs, even after the rotation from cash to gold. We discussed last week about the sheer size of these equities and bonds markets compared to gold and silver. Whilst 2.3% is up, and what is normally less than 1.1% for gold share, it is a quarter of where it was in 2011 and 2012, the last time gold reached all-time highs, and when gold ETFs represented 9.3% of Bank of AML's private client investments. There's still a bit of room to grow there, isn't there? Check out this next couple of charts here. Private clients have reduced cash 3 consecutive weeks in a row. You can see the different events there, from US fiscal cliff, CNY, Trump, Fed tightening and trade war, and now COVID-19. Everyone's pulling their cash out. And this chart 6 here, precious metal ETF holdings as percentage of ETF portfolio rise. So around 2015 to 2019, we might have seen around the bottom of that dip, and now we've seen a reasonably quick, sharp increase there in 2020 as people start piling into gold ETFs. So let's just pause for a bit and consider that second chart we just talked about in the context of gold already now being near those same highs seen in 2011 and 2012. Those concerned they have somehow missed the boat on gold, given its performance this year, are more likely to be missing the point. Smart money is flowing into gold and silver now on just the warning signs of the effects of currency debasement. When the warning signs start to play out in real hard numbers, we could then expect to see the masses pile in even more. The updated Bank of AML total returns quilt shows gold firmly in position 1 for this year. For those that haven't seen the quilt before, this shows all the different types of investment classes that people can jump into and where the Bank of AML positions them. Right over on the far right there, you can see gold at the top of the charts. Cash is just at 0.5%. The S&P 500, very low. Interesting, Hartnett also looks at the macro environment and sees what these unprecedented stimulus measures debasing the US dollar may, and already in part, see play out in what he calls a structural shift, encapsulated in 5 key points. First point, the current era of bigger government and smaller world. The second point, unconventional fiscal policy accelerated by pandemic, heralded by higher gold and weaker US dollar, best positioned for via commodities, HY bonds, and long ROW stocks versus US stocks. Third point, the 2010s were a decade of liquidity, globalization, and profits. The 2020s are to be a decade of deficits, localization, and redistribution. And the last point here, the war on inequality means unconventional monetary policies of the 2010s to be replaced by unconventional fiscal policies of the 2020s. MMT, or Modern Monetary Theory, UBI, or Universal Basic Income, debt forgiveness, or debt jubilee, and unionisation. This next table maps out all this in some finer detail. We'll quickly try and explain this. Chart 8, US dollar debasement to incite structural shift. In the 2010s, all of our focus points there. If you've lived through the last 10 years, I'm sure a lot of them make sense. And the 2020s, what we're looking forward to here. Instead of Wall Street, we're thinking Main Street. Bye-bye boomers, hello millennials. Instead of corporate buybacks, we're thinking wealth taxation. Unfortunately, we've got the words war in there. Unionisation, dictatorships, high volatility, stagflation's in there as well. History is littered with such structural shifts. For newer listeners who may have missed it, there are two must-read articles on our website if you want to check it out on exactly this topic back in May. Ray Dalio, head of the world's largest hedge fund, spelt out the rise and fall of empires and the start and end of long-term debt cycles. Topically, Dalio is also recorded with this quote: "If you don't own gold, you know neither history nor economics." Well, that's news today. Hope we've kickstarted your week in style. Make sure you tune in tomorrow for everything. Well, it's Tuesday, so it'll be everything cryptocurrency. Remember, you can always go over to ainslieBullion.com.au and read and also listen to any of our news. You can also purchase any of our gold, silver, platinum products as well. AinslieWealth.com.au for anything cryptocurrency. We'll catch you tomorrow.